Good afternoon, ladies and gentlemen, and welcome to the BLANCCO Technology Group PLC investor presentation for the full year results for the year ended 30th of June 2021. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted any time via the Q&A tab situated in the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question submitted today, but will publish responses where appropriate to do so. These will be available via your Investor Meet Company dashboard and will be notified by email once these are ready for your review. I'd also like to remind you that this presentation is being recorded. We'll shortly submit a poll, but in the meantime, I'd like to now hand you over to Matt Jones, CEO, and Adam Maloney, CFO of BLANCCO Technology PLC. Good afternoon.
Good afternoon. We're really excited to be here. In fact, I'm excited to be in the same room with Adam for the first time in 20 months as I traveled over to London. So I think the plan would be we're going to turn off our cameras during the presentation, come back at the end for questions and walk you through the presentation. So Adam will kill the camera, and if we go to slide 1, I'll kind of walk us through. Oh, looks like we're doing a poll first. Okay. So we're going to walk through I think 5 things today. I want to give you some highlights of our fiscal year just ended in June 30th. Do a quick company overview because many of you have heard our presentation before, but I thought it'd be worth covering just a few items of who we are and what we do. Adam will walk through the growth drivers and financial review. I'll come back and provide a market update, really focused on enterprise, and then do a summary and outlook, and then we'll take your questions. So we'll just jump right into this. So again, we'll go through each one of these details and a lot more as Adam and I do the comments, but from a financial perspective, I think we're really proud of what happened this year. And so, we grew revenue by 9%, but had a really strong second half that Adam will walk through, growing at 19%. And that growth in the top line really filtered down below in operating profits and EBITDA and cash. And we're really happy that all 3 of our trading geographies and all 3 of our markets grew. And again, Adam will go through those details in a minute. The other thing we spent a lot of time in 2021 was, developing key partnerships and announcing those, because especially in the enterprise side, channels are such an important mix for us. So now we're fully integrated with ServiceNow. In fact, I'll walk through a quick business case of who ServiceNow is and what they do for us. We've had a partnership with Amazon Web Services for about 18 months, but have just last week announced the highest status of partnership with AWS. We're an ISV Accelerate partner, which puts us in a position of one of only 200 or 300 partners they have in the world. And I think that's a really interesting opportunity. And then we announced several new partnerships, including Infosys and Lenovo and Accenture and others. And so all those are really important partnerships as we think about growing the enterprise space and our company going forward. As a quick overview, I think a couple of things. Again, if you've seen us before, it might be a review, but one of the things that's important to us is for a smaller company, we're very worldwide. So we have offices in 15 countries, we do business in 70 countries, and we generate revenue all around, a third in North America, a third in Asia, and a third in Europe. The other thing that's very important to us is, as a software company and technology company, is really our technology. And so we spend a lot of time on technology, including having 38 patents granted or filed. We're very focused on making sure that our erasure product is the best in the world. And so we're accredited by over 25 erasure standards and security approvals, which is really important for our customer. And the other thing that's important to us is we have a very strong ESG platform, both externally, again, I think Adam will talk a little bit about, and internally as we measure ourselves, because many things we can do can help our customers meet their ESG goals as well, too. And so again, as we talk a little bit more, you'll see some of the ESG things we do for our customers and what it means to them. The other thing is one slide about the technology we provide. And if you think about what we do, the easiest way to think about BLANCCO is that we can erase data off any device, any medium, permanently and auditably. So it doesn't matter if it's a mobile phone, it doesn't matter if it's a laptop, or in the biggest data centers, we can erase that data. And then what we do is make sure we have a management console that can document what's been erased, when it's been erased, because often from a compliance and security perspective, it's not just important that you erase the data, that you know you've erased it and you can prove you have. And so as you think about our technology, think us about the leading software company around erasure and sustainability and what we can do that on any device that a customer would have. So 3 markets we operate in. and I'll touch on each one briefly. There's a lot of similarities across the markets and the way we sell and the products we develop for them, but each of them are a little different. So the enterprise market, this is really focused on global 5,000 customers. They tend to have large IT organizations. The biggest competition we have in this market is physical destruction, where instead of using software erasure, they actually shred the equipment. There's really limited competition here and really the fastest growing market for us. And this is a market where channel is very important to us. So as the enterprise, you'll see as we go through the numbers, fastest growing market, maybe most important market for us, and one we've had really good success with. The second market's the mobile market. And we think about the mobile market, this is really the secondhand phones. When you take your mobile phone and turn it in to buy a new iPhone 13, that phone will get diagnosed, it'll get erased and refurbished. And we work with all those customers through that ecosystem to work with them. So it's one that's the most competitive market from the number of competitors we have, but I think a very nice growth market for us and one that we've done very well as well too. And finally, the last one is the ITAD market. That stands for IT Asset Disposition. These are companies that work with enterprises. When your equipment comes to end of life, your PCs or your tablets, you would give this to an ITAD, and the ITAD will take it back and erase it. It's a market we've worked in for 20 years. We have a majority market share, probably a 70% market share in the ITAD market, and one that has been a really kind of a important market for us since we began the company 20 years ago. The last thing I'd touch on, I think, pass over to Adam, is kind of update on COVID. I think we've talked about the impact on COVID on our business over the last kind of two halves. And I think the nice thing we see is that we're back to, I think, pre-COVID levels in terms of our sales cycles and our momentum in the marketplace. In fact, what we're finding is many of the permanent changes you see in the workplace, like hot desking, working from home, all increase focus on some of the things we can help with in terms of erasing data. So not only do we think we come out of COVID kind of back to where we were 18 months ago, we think there's some interesting new use cases for us and pent-up demand for our services that we didn't see pre-COVID. And so we're really excited about getting back to normal here, me traveling to the UK and business growing at rates we think it can grow and going forward.
Afternoon, everybody. This is Adam Maloney. I'm just going to take you through a few of the growth driver slides for the business. And one of our key growth drivers is around sustainability, and really the most direct issue that we take on is around e-waste. And e-waste is a growing problem, as we've all seen in the press over the past couple of years. UN reported last year that 54 million tons of e-waste were generated in 2019. And that number is expanding very quickly. It's expected to hit 74 million tons by 2030. And they're also saying that of the e-waste generated in 2019, only 17% was formally collected and recycled. So there's huge amounts of equipment which isn't being recycled at all. And the particular problem with computer equipment is, in order to make sure that data can't be recovered from those devices, they have to be shredded into very small fragments. And if they're shredded into very small fragments, it means it can't be used for recycling. And it also means that the chemicals that are involved in the manufacture of computer equipment, such as mercury and CFCs, are often released into the soil at the point where they go into landfill. And that's even more damaging than just the mass of waste that's come around. So UN have set a target to try and increase the amount of recycling that's done at the moment to around 30%. But we're a long way from that. I mean, our estimates are that around about 90% of all computer equipment ends up in landfill. So a very small proportion actually goes back into the circular economy, and that's really what we're looking to encourage, and that will help us to grow the business. So the way that we're able to manage this, and if we look at the impact we had in the most recent financial year, we actually erased data from over 54 million devices last year. So that's obviously a huge number of devices. That's 68 million kilos of e-waste that's been saved if those devices then came back into the circular economy. And the carbon saving from recycling those assets could be as much as 5.6 billion kilos. And the carbon saving is so significant because computer assets tend to be very energy efficient in their use, which means that only a very small proportion of their carbon footprint comes once it starts being used. So as a good example, for an iPhone 12, it has carbon emissions of 110 kilos over a lifetime, but only 13% of those emissions come from when it starts getting used. So the 87% comes in the manufacture, in the packaging, and in the distribution. So if we can take steps to make sure that we don't have to go through such processes on the manufacture, then that's going to obviously be a big carbon saving, and we're all seeing a lot of focus on that at the moment. One of the ways we're attacking this is to enhance the reporting that we can provide for our customers. So all of our customers at the moment have a management portal, which allows them to log when every device was erased. And so you can have an audit report for every single device with the serial number, the date that the erasure took place. And we are developing an ESG dashboard. You can see a mock-up of here. This isn't live yet. It should be live early in 2022. And this dashboard will allow customers to log the number of devices that they've erased, what type of devices they were, what the cumulative weight of all of these devices are, and what the carbon saving could potentially be. Companies such as us and pretty much every other listed company is under some significant pressure now to do better and better from an environmental perspective. So us being able to help those customers talk about stats, about the positive environmental impact that their practices are taking place should be really helpful in helping us to grow awareness of data erasure and hopefully get that number of 90% of devices being destroyed down, and hopefully a much greater proportion being reused. The more traditional growth driver for us is around data privacy. And data privacy regulation is becoming more and more prevalent. And what we've seen in a recent Gartner report is that they estimate that currently 25% of the world's population is covered by some form of data privacy regulation. But that's increasing rapidly. And that by the end of 2023, that'll be 75% of the world's population. So a really big ramp up in the amount of regulation that's out there. The penalties that are assigned to it are now increasingly punitive. So we've seen recently a very large fine of over £600 million issued to a large technology company. So that's forcing companies to spend more and more money on their IT infrastructure, on data privacy, and the spending, as we say here, Gartner saying 2024, $15 billion will be spent on data protection and compliance technology. So these are all things that will help drive growth in the business. And also in that Gartner report, they regularly publish this, what they call a hype cycle, which shows the stage of development that the solution is in. And as of July 2021, and we've been tracking this for a few years now, and we have been tracking this cycle pretty closely, we are now at what Gartner called a slope of enlightenment. We would probably know it more commonly as early stages of mainstream adoption. So this means that more and more people are becoming aware of the technology, but it's still at the very early stages of adoption. So there's plenty of scope for more growth here. So I'll now move on to the financial highlights. This is the income statement. Matt touched on some of the numbers here earlier. Those of you that attended the presentation we did 6 months ago may remember that we reported half-year numbers where we were pretty flat year on year, largely because of some COVID slowdown on the sales cycle, but we had already seen a very nice pickup in the second quarter of the year, and we were feeling very confident and were forecasting strong growth coming through in the second half of the year. And I'm pleased to be able to report that we have achieved that. Revenue grew by 19% in the second half of the year, taking us to a 9% growth for the year overall. We did get some currency headwinds because if we adjusted for the same currency, we would have grown by 12%. So very, very nice growth in the business, and I think we're really pleased to see that the business was as resilient as it was through that challenging pandemic period, and actually has benefited from some cost savings related to the pandemic. So you can see here the operating margins went from just over 12% to 14.5% in the year. With us having such a geographical spread, there's always been a lot of travel in the company, and that obviously reduced quite significantly last year. So that saw a cost saving come through. Although we're starting to see the beginnings of some travel, it's not going to get back to where it was, and we think we think use of technology means that the need to travel quite as much as we used to is going to be lessened. But it will come back to some extent. but probably 60 or 70% of where it was before. So I do expect cost operating margins to probably flatten off a little bit this year before we then settle into a more normal pattern as we go forward. But you can see here, operating profit went from 4 million to 5.3 million. It's a growth of 42%. EBITDA went from just over 8 million to just over 10 million. So yeah, really good progression, really pleasing to see the company performing so well in what's been a very challenging period for everybody. We thought, Matt and I both joined the company a little over 3 years ago, and so this is the third full financial year that we've been with the company. We thought it a good time to reflect on how the business has progressed over that time. And you can see here the top chart is around the revenue progression in the business. So in FY18, we did just under 27 million of revenue. That's 36.5 million now. So that's 11% growth per year over that period of time. So really pleasing growth. And then similarly, from a profit perspective, operating profit over the same period has gone from 2.9 million to 5.3 million. So it's a growth rate of 22%. So very consistent revenue growth, very strong profit growth across the whole 3-year period. And yet there's no reason for us to feel that this can't continue. On the balance sheet, it's really a fairly straightforward balance sheet. Cash is always the headline number. And as you see on the chart on the right-hand side, we had a net debt balance when we joined of almost £3 million. And as of the end of June, that had been turned around into a positive cash balance of just over £10 million. So really good cash generation from our activities as well, particularly in the last 12 months. The cash has gone from 6.7 million to 10.1 million. So just under 3.5 million of cash generated from operations in the year. So really pleasing. Cash collections are very strong as well. You'll see debtor balance has gone down by just over £1 million, even though revenue is up 9%. So yeah, really pleasing to see the business profit turn into cash. Now, Matt mentioned the 3 markets we operate in earlier, and we thought it was also a good time to have a look at the progression over the 3-year period for each of those. Enterprise, we do believe, has been to be our strongest growing part of our business. When we joined 3 years ago, it was actually the smallest part, and now it's by some margin the largest part of our business. Enterprise has been growing at 18% a year over the last 3 years, and that's been driven quite significantly by our channel activity. So as Matt mentioned, a number of our channel partners that we've secured recently, but they've really not contributed significantly to the channel revenue so far. That should come in future years. Our existing channel base has seen its revenues increase by 27% last year, and now represents 46% of the total enterprise revenue. So really good performance there. You see, even in the last 12 months, despite the challenges, it's grown by 24% on a constant currency basis. So really strong progression in enterprise. We think that's very much driven by ESG themes, and we expect it to continue. Although 20+% every single year would be a challenge, we think mid-teens would be a good performance. From an ITAD perspective, we've always felt ITAD would probably be the slowest growing part of our business. Matt mentioned earlier, very significant market share that we have, so winning market share is challenging, but the ITAD market is growing. And we've seen growth in ITAD of 10% a year. We feel as though that's a very good performance. We didn't think it would grow as quickly as that, but we're encouraged that it's done as well as it has. And on the mobile side, mobile is a little more difficult to explain, so that the growth has been a bit more erratic, and that's primarily because we did have one large customer in mobile where the contract ended at the end of calendar year 2019. That revenue has been replaced with other contracts, but it meant there was a little bit of disruption in the growth, and that's seen us only grow mobile revenue this year by 1%. But if you adjust for that one,
Just bear with me 1 second, please. I think you may have just lost the guys.
having some technical issues. Just bear with me for a second. I can't
Adam,
seem to.
hi, you're back now. So we lost you for momentarily there. Can you see everything? We're back on.
Yes, I can. Sorry, everybody. I'm not sure. Do you know where we got up to, Paul?
We got up to, let me just go, you were just here, we were talking about, I think, the mobile revenues.
Okay. Apologies, everybody. Yeah, just to go over mobile again. So mobile grew just by 1% this last year. That's a little distorted because we had a significant contract in the year before, which came to an end at the end of 2019 calendar year. So that had $1.5 million revenue last year. It wasn't repeated this year. It's been replaced with other business. So underlying growth has been 14% in mobile, both in the year that's just gone and also over the 3-year period when we adjust for that contract. I shall move on to the next slide. And so this just backs up what Matt was saying earlier, that we roughly have fairly even split in revenue, with a third coming from each of North America, Europe, and APAC. The growth rates all look pretty similar. Very pleasing to see that all 3 geographies have grown over the past year. Europe growing a little bit slower than the other regions, probably because it's taking longer to come out of the pandemic than we've seen in North America and APAC. But they're all performing well, and as we move into this new financial year, we're very encouraged by progress. So part of our confidence in the business is around how sticky our customers are and the high levels of repeat business that we have. So we saw last year that 81% of our revenue in last year came from our pre-existing customer base who just repeat buying from us. So they repeat buying from us because, firstly, there's very few options. There's very few credible competitors out in the market. The only way you could really take a different approach is decide you're not going to recycle your equipment. You don't want it to go back into the circular economy and you want to shred it instead. And that would be an odd step for anyone to take in the current environment. So we don't tend to lose very many customers. And you can see here the stat that we've got 98% retention of our large customers are sticking with us. And so, yeah, we're really encouraged with that. And again, while we question why do our customers stick with us, we run net promoter scores with those customers to see if they would recommend us or not, and we score extremely well. So last year we scored 48, this year 57.5. Industry average is generally considered about 35 in the software sector. So we're performing well above industry average, keeping a lot of customers, and that gives us great visibility on the revenues that we should get in subsequent years.
Yeah, thanks, Adam. So I'll come back and talk a couple of slides. And so I thought it's always nice to talk about some use cases to help you understand how our customers use our technology and why. So here's a great example. It's the Australian Department of Defense, and as we've talked about a couple times, they have always they've always erased their data by physical destruction. They've done it for years and years, and they realized there was a better way to do that. They were shredding $20 million of equipment every year, but the issue they had is there was no software out there they felt met the criteria they needed from a security and compliance perspective. And BLANCCO obtained what we call common criteria accreditation in June 2020. We went through a proof of concept with them. They got very comfortable that they could move away from physical destruction. And so not only, I think, do they have cost savings and environmental savings, they found really that they had greater security measures as well too, because now all their equipment was erased on-site on on-site data erasure rather than being transported to a physical facility to be destroyed, which things can always fall off a truck, or there's always issues with physical destruction. And secondly, they had a report that allowed them to see exactly what was erased, when it was erased. So I think it's a great example of how we're moving people from even the most demanding customers with the highest levels of security. We can move them from physical destruction to data erasure. We mentioned one of our new big partners is a company called ServiceNow. So ServiceNow is the largest IT asset software player in the world. So I think about 70% of the global 2,000 use ServiceNow to manage their assets. And this is a customer, a big American global information technology company that made the switch over from Microsoft to ServiceNow. As part of that, we've embedded both our erasure technology and our reporting technology as part of ServiceNow. So it made it really easy for the customer when they moved to ServiceNow to implement BLANCCO, so that now through their current processes they use to manage their assets, whether it's a laptop that moves from one employee to another and needs to be erased, they can click on this module and use erasure immediately through us. So it's just an example of how we can differentiate ourselves in the marketplace with a partner like ServiceNow. And as Adam mentioned, it's a brand new partnership, so we're really optimistic about where we can take this partnership over time. So I'll just do a quick summary of kind of where we are, and then I think we'll open up for questions. So, really strong revenue, profitability, and cash over the last 3 years. BLANCCO is clearly the leading data erasure company in the world. The growth rates were, I think, strong through the year, but especially strong in the second half. And, the nice thing with the growth was across all geographies, all markets. So it's kind of both deep and wide. And that growth at the top line, I think, drove nice profits and cash flow on the bottom line. And I think we're excited because a lot of the growth drivers that are helping drive our business forward, whether it's compliance and privacy or security or ESG, are there over the short and long term. So as we think out further down the road, we're really excited that we're kind of over the COVID impact and we can drive our business forward. So I think that's the last piece of presentation. I think we'll hand it back over to
Matt, Adam, thank you indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions just by using the Q&A tab situated on the top right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. Just while the team take a few moments to review those questions we've had in already, I'd like to remind you that a copy of the slides and the published Q&A can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you will be redirected for the opportunity to provide your feedback in order the team can better understand your views and expectations. Matt, Adam, if I may just ask you to click on the Q&A tab and just where appropriate to do so, just read out the question, even who it's from, and give your response. That'd be great.
Okay.
Yeah, no problem. Okay, so the first question is from Chris. And it's, how is the ESG agenda driving things to switch from a physical destruction to erase and recycle? So I'll take that question. So I think, as you mentioned, as we went through the presentation, companies are under increasing pressure. I mean, we as an organization get letters regularly from shareholders asking us how we are approaching ESG internally, and we expect most of our customers get something similar. And so everybody's under pressure to do better, and it doesn't make any sense to be putting all of your computer equipment into landfill, but still the biggest companies in the world are doing it. So, the whole ESG agenda is really pushing companies to think more and more about what it is they do with their equipment. And obviously, the more that doesn't go into landfill, the more we'll use data sanitization, because obviously you've got to clear the data before you recycle or put the asset back into the circular economy. And so really data sanitization is the only secure way of being able to do that.
Yeah, I would say also, one of the things you saw that Adam talked about is this kind of new dashboard feature we're going to have, where we're going to be able to show customers now, by using our software, that they can improve not only their electronic waste, but also their carbon footprint. So I think we're trying to put in place a bridge to their ESG goals in the company, that they can show that there's a very simple way that data erasure can help them meet that. So I think we're trying to give the tools to our customer that helps that agenda as well too.
Second question is from Harvey. And he said that we've highlighted revenue growth of 9%, of which 19% was in H2. Is either of these a good guide to growth on an ongoing basis? What would be a normal H1, H2 split? So I might take the last part of that question first, actually, because what we tend to see is that the first quarter of every year tends to be a little slow. So we're a June year end. So, your first quarter is through July, August, September, the summer months. And that tends to pretty much every year be the lowest sales generating quarter. We expect therefore that the first half doesn't normally turn out quite as positively as the second half. As we get really the Q2, Q3 and Q4 are all pretty similar in terms of the revenue generation. So it's only that first quarter where we see a little bit of seasonality from the quiet summer periods. In terms of
but usually probably not as dramatic as 9 and 19%. Because part of that was COVID affected, right?
No. So yeah, I mean, the revenue growth for the whole year was 9%. It was 19% in the second half of the year. It's asked, is either of these good guide to growth on an ongoing basis? I'd probably say we'd be somewhere in the middle of those two. I think would be a normal period. We feel, when we said earlier, we've grown at 11% a year over the last 3 years. That's despite the slowdown for a good 6 months down through the COVID period. So I think, overall something in the mid-teens has been where we tend to be. We do have to be a little conscious at the moment of currency headwinds. So we see over a third of our revenue is generated in US dollars. Around about a quarter is in Japanese yen, and sterling has gained a lot of strength against both those currencies over the last couple of years. So we do see some currency challenges, which means our constant currency growth would always be stronger than our actually reported number. But yeah, hopefully answers the question somewhere in the mid-teens. Next question is from Andy. So it says, with a great retention rate, how do you look to win new clients, and what is the strategy to close the gap between EBITDA and bottom line profit? So
maybe I'll take the first one if you want to do EBITDA and profit. So yeah, I mean, I think part of this push is, we obviously want to mind our base, and we have great retention rates, as you mentioned, a lot of revenue coming from them. But, driving a new customer is important. Part of that is this channel play we talked about, right? So we can push out to new customers through these channels we couldn't get otherwise. So I think you'll continue to see us push channel revenue up. We said it was up from 43 to 46%. I think as we go out, we look at that going to the 50s and the 60s as a channel play. And I think that gets us to new customers. I think being innovative in the products we bring out will continue to allow us to drive to new customers. So I think we try to have the right balance, making sure we take care of our existing customers, grow within that. But there is a push to drive to new customers as well, too. And there's a big customer base out there that still does, for example, physical destruction, that we know as we can change their attitudes, they're all, kind of greenfield opportunities for us.
Yeah, so the second part of that question was strategy on closing the gap between EBITDA and bottom line profit. And obviously, the definition of EBITDA is your earnings before depreciation and amortization. And that is typically the gap between EBITDA and the bottom line profit. And we do have a fair chunk of depreciation and amortization go through. Last year it was 4.9 million. So there is always going to be somewhat of a gap there. The company is traditionally always capitalized a fair amount of costs, and it amortizes a lot of costs. So last year in R&D, for example, we capitalized 4.9 million and amortized 4.1. So it was £800,000 net sort of cash credit to the P&L. The year before that was over £1 million. So I think there will always be a gap of whatever the depreciation and amortization charge between the two. And there's not much that we can do about that. But as obviously the top line gets bigger, hopefully it'll be a less significant proportion of the revenue number. So the final question we've got at the moment, I believe it's the final question, but please still send in any others that you might have while we answer this one. It's again from Harvey, and it says, why has there not been any new competition? Are there any emerging competitors? So
yeah, maybe I'll take that. So it depends what market we talk about, our competition. So in the enterprise market, we have some very small competitors, but we're by far the biggest. And I think, as we continue to expand our channel, our technology, again, our competition is not another software player in the enterprise or ITAD space. It's physical destruction. Mobile's a little different. There are 4 or 5 competitors out there that do similar things to us. We've spent a lot of time over the last 18, 24 months focusing our product to make sure we had the best, most competitive product so we can take market share away. But it is in the enterprise or in the mobile space, it is a competitive market. There are competitors out there. And for us, it's about taking market share and growing the market. So it really depends on what market it is. Are there emerging competitors? Not that we see. I think what we see is this is a niche market, right? So it's not something that some huge company is going to come in. In fact, most of the big technology companies in the world that you would think would come there are probably customers of ours. People like Microsoft and Apple and Salesforce and Amazon are all customers of ours. And so I think from that perspective, we don't see big companies come in, but we keep our eye out making sure that we have the best product. And when we keep an eye if new competitors would come in, how would they come in and how would they differentiate?
And we've had one further question come through, which I can take. It's from Ken. And it says, can we discuss earnings per share growth and our attitude to future dividends? So I'll take the dividend question first. I mean, from our perspective, we are generating good levels of cash. We ended the year with £10 million of cash, but we do still have some M&A ambitions. We feel that the best way to deliver value for shareholders is through growing the business as quickly as we can, and that they'll get a better return from that than probably getting a somewhat modest dividend. So our view is that we'd like to use the cash that we have to help us with an M&A strategy. The M&A strategy would very much focus on the enterprise part of the business. If we are looking for companies who would have something complementary around data management in some way that would fit very nicely alongside our Asia solution, would enable us to have a much higher ticket value on the solutions that we provide by doing more than just erasing the data. So I think we feel as though we want to be cash positive and we want to use that to grow the business rather than to give a dividend. So yeah, I think for us, it's unlikely there'll be dividends in the near future. In terms of earnings per share growth, so we have been growing earnings per share reasonably strongly over the last few years. Earnings per share tends to be impacted a lot by exceptionals and the bits that we tend to have underneath our adjusted operating profit line. This year, for example, though, I mean, we had some exceptional incomes come through, which were largely the release of some provisions in relation to past acquisitions. So we saw an exceptional income come through, and that gave a better earnings per share number. But it probably doesn't really reflect the real underlying trend in the business. So I think EPS, is obviously very important for a lot of shareholders, but I tend to think that it tends to sometimes distort what's really happening in the business. But obviously, we're going to seek to continue to grow the EPS number.
I think you've actually covered every single question off there, guys, that we've had through. And if there's any further questions that do come through, of course, you can review those post-event and we can publish responses where appropriate to do so, and they'll be available on the Investor Meet Company platform. Matt, just before we redirect investors to give you some feedback, perhaps I could ask you for a closing snapshot, and we can redirect them. And I can see just another question's just come in. If you did want to take that, do feel free.
Sure. Well, first of all, thank you for the time today. If you didn't know Blanco before, I hope you learned a little bit. We're the leading data erasure company in the world. Our growth rates were really strong over the last 3 years, as we've shared, and we're really excited, especially now that we've come back to pre-COVID levels, and our second half have really grown. Our growth was really wide and deep across all geographies, across all markets. And finally, I think the exciting thing for us is these growth drivers that we talked about today about security and ESG and compliance and privacy are all long-term tailwinds for us that we think can drive the business forward over the next 3 or 4 years. So really looking forward to not only the growth we brought the last 3 years, but how we can drive that forward over the next 3 or 4.
That's fantastic. Matt, Adam, thanks again for updating investors today. Could I please ask investors not to close the session? You'll be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of BLANCCO Technology Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon.
Thank you.